So now let's move on to the next variance, which is variable production overhead variance. Okay. Now, under variable production overhead variance, also we have to calculate basically two types of variances. One is the expenditure variance and efficiency variance. Okay, so let's go through a question so that we can understand the concept. The variable production overhead cost of product P is as follows. 2 hours at the rate of 1.5 per hour. 1 unit requires variable production overhead cost $3 per unit. Okay, so during a period 400 units of P were made. The labor force worked 760 hours. The variable overhead cost was $1,230. Okay, so basically if you analyze, to produce 1 unit, the variable production overhead requires 2 hours at the rate of, it absorb the cost at the rate of 1.5 per hour. So therefore to produce 1 unit you need $3. Okay, so during a period 400 units were made and they actually worked 760 hours at $1,230. They incurred $1,230. So basically, variable production overhead, as I told you, it consists of expenditure variance and efficiency variance. So the variable production overhead total variance, how do you calculate? Basically, like how we calculated direct material total variance and direct labor total variance. So likewise, you have to apply the same calculation, which is the difference between your planned overhead cost versus actually incurred overhead cost. So actually incurred 1,230 on 400 units, but you should have incurred per unit $3. Okay, so $3 times 400. How do you calculate that? Variable production overhead cost variance. So basically, on 400 units, you should have incurred 400 times 3, which is 1,200. But it cost 1,230. Okay, more than the budget, more than the planned cost. So therefore, there's an adverse variance of $30 on the variable production overhead cost. This is a total variance. This total variance consists of expenditure and efficiency. How do you calculate the variable production overhead expenditure variance? Basically, you have to take how much was incurred, 1,230. To produce 400 units, you should have incurred per unit 1,000, 1.5, right? So actually used hours were 760. So 760, if you had paid at the rate of 1.5, how much you should have incurred? 1,140. So here what we are doing is actual hours taken times the budgeted rate or the standard rate 1.5. So we should have incurred this much on 760 hours, whereas we incurred, it cost 1,230. So therefore, there is an adverse variance of 90 expenditure variance, because we plan to incur this much 1140 and we incurred 1230, right? So the other one is the efficiency variance. So here basically we have to compare the standard hours taken with actual hours taken. So standard hours, we should have taken 2 hours to produce 400 units. So therefore that will be 800 hours. Okay, so we are going to calculate how efficiently the labor force was used. Okay, so therefore if you take 400 units, we should have used 2 hours per unit. So basically 800 hours to produce 400 units. However, to produce 400 units, we used only 760 hours. Okay, so we have used our labor force efficiently. So we have used here our labor force efficiently. So therefore, we have a favorable efficiency variance of 40 hours. And if we had used the standard rate, it should have been $60. So that will be a favorable variance, right? So if you compare 90 adverse plus 60 favorable rate and efficiency, okay, so you will arrive at the total variance of $30 adverse variance. Okay, so this is how you calculate variable production overhead cost variance. Now let's move on to the fixed production overhead cost variance.